Okay, let's dive into this. Welcome to The Explainer. So picture this. You're finally doing the responsible thing. You're saving money every single month. You're moving $100 here, $200 there into your savings account, and honestly, you should feel great about that. You've got the discipline down. But eventually you kind of hit a wall, right? You start wondering, how do I get my money to work as hard as I do? Well, that's exactly what we're going to tackle today. We're looking at the exact step-by-step path to move from simply saving your cash to actually investing it. Imagine you open your banking app one day and you realize something a bit shocking. Let's say you have $10,000 sitting in a standard savings account, and it's earning something like 0.5% interest. Do you realize what that actually means in reality? It means that after an entire year of strict discipline, your money has made a mere $50. Yeah, just $50 for letting 10 grand sit there doing nothing for 12 full months. And that brings us to a somewhat controversial truth. Saving money alone, it's almost never going to make you wealthy. Now, to be absolutely clear, saving is incredibly important, but it is not the final goal. You see, your money actually has two very different jobs. Savings are designed to protect your money. Investments, on the exact opposite hand, are designed to grow it. They serve completely different purposes in your financial tool belt. And this brilliantly illustrates the massive opportunity cost over time. Let's say you leave that same $10,000 in a typical savings account earning 1% interest for 20 years. You'd end up with about $12,200. But wait, if you invested that exact same 10 grand into something like the S&P 500 stock market index, which historically averages about a 10% return over long periods, you would have roughly $67,000. It is literally the exact same starting money, but compounding creates a completely different, totally life-changing outcome.
So if the math is that obvious, why doesn't everyone just immediately transition to investing? Well, the gap isn't really about the math at all. It's about human psychology. Saving feels inherently safe, while investing feels inherently risky. When your money sits in a savings account, it doesn't fluctuate. It doesn't randomly drop by 5% on a random Tuesday afternoon. Investments, however, do move. They go up, they go down. And that emotional volatility, it creates severe analysis paralysis for a lot of folks.
Look, it is completely fair and rational to not want to lose your hard-earned savings. And that is exactly why the transition from saving to investing shouldn't happen all at once. To relieve that anxiety, we're going to walk through a finite, highly manageable 5-step path. This structured approach ensures your transition happens slowly and safely, meaning your overall financial security is never put at unnecessary risk. Step 1. The emergency fund. This is all about protecting your investments from life itself. Before you invest a single dollar, you absolutely need 3 to 6 months of living expenses strictly saved in cash. Why? Because the biggest reason people panic sell their investments at a steep loss is simply because they suddenly need cash too soon. A job loss, a broken down car. Life happens. This emergency fund acts as a protective fortress. It explicitly shields your long-term investments from your own short-term life emergencies. Once your emergency fund is locked in, we move to step 2, mental separation, or bucketing your money. This is a simple psychological trick, but it dramatically reduces investing anxiety. You're going to mentally separate your funds into 2 distinct buckets. Bucket 1 is your safety money. This is your emergency fund, and it doesn't move. It is your absolute bedrock. Bucket 2 is your growth money. Now, you have to give this specific bucket explicit mental permission to fluctuate. Why? Because its entire job is to ride the waves of the market and grow over time. Recognizing this separation stops you from checking your investment accounts with total dread every single day.
Next up is step 3, start small, which is really all about building the habit.
There is this massive beginner myth out there that investing requires thousands of dollars up front. Completely false. No way. Today, a ton of modern brokerage platforms will let you open an account and start investing with just $50 or $100. When you're first making this transition, your primary goal is not making massive, life-altering profits right out of the gate. Your goal is simply building the habit of investing regularly. Setting up that consistent routine matters far more than trying to time the market perfectly.
And that flows perfectly into step 4, keep it simple.
Please don't make the massive mistake of jumping straight into high-risk strategies like aggressive day trading, complex options, or wild crypto speculation. Focus on index funds. These simply track the overall stock market. So, instead of trying to guess and pick individual winning companies, you are investing in hundreds of companies all at once with a single purchase. This gives you instant diversification, massively lower risk, and reliable long-term growth. It's incredibly simple, and most importantly, it works.
Now, I know this strategy might sound a little bit boring, but it comes with some of the highest credibility imaginable. Even legendary investor Warren Buffett champions this exact approach. He repeatedly recommends low-cost index funds for most everyday investors. If this reliable, straightforward method is highly recommended by one of the absolute wealthiest investors in human history, it's definitely the perfect foundation for us.
Now, what's really interesting about this slide is seeing the sheer, undeniable magic of compounding at work. Let's say you invest just $300 a month consistently for 25 years and the market averages an 8% return. You would end up with roughly $285,000. But look at this breakdown. You only actually contributed $90,000 out of your own pocket over that entire time. The rest, almost $195,000, comes purely from investment growth. That is your money going out, working hard, and making more money for you.
Of course, capturing that massive growth leads us directly to our final stage, Step 5, discipline and time.
When markets inevitably go down, and they will, the daily news headlines get incredibly dramatic. Human nature screams at us to panic. But maintaining your discipline during these moments is exactly what separates true investors from reckless gamblers. Think of your money through this analogy. Saving your money is like storing seeds in a glass jar. You are protecting them perfectly, they are completely safe, but absolutely nothing is going to grow in there. Investing, however, is like taking those seeds and planting them in the dirt. At first, it looks messy, you don't see results right away, and a storm might even roll through. But over time, with patience, things grow and eventually you yield something far, far bigger than the original seeds you started with.
Now, I know exactly what you are probably asking yourself right now. Wait, what if the market crashes right after I plant my seeds? It's a fantastic question, and honestly, it's every beginner's biggest lingering fear. But you need to validate and internalize the fact that market crashes are completely normal. They aren't anomalies, they have happened dozens of times throughout financial history.
So the crucial point here is how you choose to reframe those downturns. Long-term investors actually view market drops as an incredible opportunity. Think about it. When prices drop, your consistent monthly investments are suddenly buying more shares on sale. You get way more bang for your buck. This means when the market inevitably turns around and recovers, your overall returns are going to be significantly stronger. Experienced investors stay calm because they are thinking in decades, not days.
Let's bring all of this together. The core takeaway of this explainer is understanding the distinct power of both tools. Saving money gives you much-needed stability. It builds that foundation. But investing gives you actual freedom. Adopting both of these mindsets and walking that step-by-step path to safely transition between them is the absolute key to unlocking a truly powerful and secure financial future. So, as we wrap up our time today, I want to leave you with a provocative thought to reflect on your own financial journey. Look at where your money is right now. Are you currently strictly in the saving stage, keeping all those seeds perfectly safe in a jar? Or have you already started planting them and investing? I would love to hear where you are on this path, so definitely let me know in the comments below. Keep taking those next steps, stay focused, and I will see you in the next explainer.